Hi, this is Francesco Nagari, Deloitte Global IFRS Insurance Lead Partner. Welcome to our IFRS 4 Phase 2 webcast. Today's webcast will cover the October decisions from the International Accounting Standard Board, and the title is IFRS 9 Deferral Ready to Go, Phase 2 Presentation Confirmed, and Disclosures Reassessed and Amended. A quiet session, but two main issues remain unresolved. Our agenda for today is structured, as always, around three items. First, I will give you the highlights of the ISB meeting on the 21st of October 2015. Then we'll spend most of today's webcast going through the detailed analysis of the ISB staff analysis, discussion, and ISB decisions. And then I will spend a few minutes at the end to talk about the next steps towards completion of this project. The highlights. The ISB has taken a few minor decisions regarding their September decision to defer IFRS 9 for insurer, including the comment period for the new exposure draft, which will be only 60 days, and confirmation that they intend to publish it for comment in December, so in a few weeks' time. They also taken the opportunity of completing the exposure of the new proposals by looking at the IFRS 9 transition provisions, which have now been refreshed against the deferral decision. In particular, worth noting is that there will be an election to reassess the business model for assets designated as backing insurance liabilities. And this will be given with an application of that classification on a retrospective basis to match the same retrospective restatement that IFRS 4 Phase 2 will be requiring for insurance contracts. This decision comes with a new set of disclosures that have also been approved in this past meeting of the ISB. The second area that was covered in the meeting is the discussion and approval that the mirroring approach from the 2013 exposure draft will be repealed from the future IFRS and will not be required or permitted. The issues on indirect participating contracts remain a final material unresolved matter together with the unit of account. Presentation of the new revenue requirements were confirmed again, and so the insurance contract revenue requirements remain, you can call it a cornerstone of the future IFRS. Disclosures were amended to eliminate a couple of disclosures, like the reconciliation of revenue to premium due and the reconciliation between P&L and OCI when the OCI solution is used. The latter old disclosure requirement has now been replaced by a new set of disclosures in line with the September decisions. And in addition, new disclosures on the VFA hedge accounting were approved, together with the requirement to disclose the CSM future release pattern, at least on a qualitative basis. Let's now move into a detailed analysis of each of these decisions, starting with the different effective dates of IFRS 9 and the new insurance contract standard. As you all remember from our previous webcast, in September, the ISB decided, after the chairman exercised his casting vote, that they would propose a package of temporary measures in relation to the application of IFRS 9 before the new insurance contract standard comes into force. These temporary measures would amend IFRS 4, the existing insurance contract standard, to permit the reporting entity whose activities are predominantly insurance a temporary exemption from applying IFRS 9 until the earliest of two possible dates. One, the mandatory effective date of IFRS 4 Phase 2, the new insurance contract standard, or the 1st of January 2021, which acts as a sunset clause for the deferral of IFRS 9. And so if IFRS 4 Phase 2 is not mandatory before that date, automatically all insurance entities that have acquired the right for deferral will be forced to adopt IFRS 9 at that point. The second part of these temporary measures will not expire on the 1st of January 2021, and that is the overlay approach, which gives entities issuing insurance contracts that implement IFRS 9 the option to remove from profit and loss some of the accounting mismatches and temporary volatility that could occur before the new insurance contract standard is implemented. At this past meeting, the ISB discussed how those measures would apply to first-time adopters and also set the comment period, as we know. The recommendation of the staff is that the ISB should expose these proposals as a temporary measure only for 60 days. And the grounds for that decision and that recommendation is that they are urgent and narrow in scope. In addition, they are also optional, so they are not going to be a mandatory requirement for entities. The staff expect to be able to publish the exposure draft in December this year, and the intention is to complete the whole change to IFRS 4 Phase 1 by the third quarter of next year. The staff noted that the predominant threshold example in the exposure draft that the ISB requested to be higher than 2/3 will be set at 75%. And so the example in the basis of conclusions of the exposure draft will say that if the total liabilities under the scope of IFRS 4 are 75% or less, the threshold will not be passed. And so we know now that there is effectively, indirectly at least, a bright line. Indirectly, just because it is not being put into the standard, but you can imagine that an illustrative example worded in that way would actually be quite compelling. The board was unanimous in agreeing with the staff recommendation to have a comment period of 60 days and approved the plan to move forward on that basis. In terms of the use of the deferral and overlay approaches by the first-time adopters, the recommendation from the staff is that first-time adopters should be prohibited from using either the deferral or the overlay approaches, as it is unlikely to be relevant to first-time adopters, and the arguments about comparability being undermined are not relevant in their case. When we looked at the discussion, a couple of points we felt it was worth bringing to your attention. First, both of these approaches require information resulting from applying IAS 39 in part or in full, and which in itself would be a new requirement for first-time adopters. So that was one of the arguments that the ISB staff put in their paper as to why first-time adopters should not be permitted to use this. Second, both approaches are intended to address concerns regarding transition and are considered not to be relevant for first-time adopters. So the recommendation is consistent, in the opinion of the staff, with the principles of IFRS 1, which are the application of the current versions of IFRS and the enhancement of comparability within entity over time. Armed with all these arguments, the ISB felt that they should unanimously approve what the staff has been recommending and prohibit either of the approaches in the temporary package by first-time adopters. Deloitte understands that there are already a number of jurisdictions that have been identifying this decision as one that will actually have negative consequences on some reporting entities that are planning to be made reporting under IFRS in that jurisdiction by national developments on financial reporting regulations. And the arguments in those jurisdictions appear to be linked to the fact that there are subsidiaries that have not yet moved to IFRS, but they are part of a group that has been producing consolidated financial statements using international financial reporting standards. And so this situation, which may be present in a number of jurisdictions, may be sufficiently robust ground for this decision perhaps to be reassessed in the coming up to the exposure draft. And if not, it will certainly be argument for those jurisdictions to comment on when the exposure draft is going to be published. In this table, Deloitte has summarized what we expect to be the timetable for this package of temporary measures. So the first step is now going to be the publication of the exposure draft, which we anticipate to be out in December this year. Then there will be a 60 days comment period, which will take us to February next year. The quarter immediately following the end of the comment period will see the redeliberations on the exposure draft proposals, and then the ISB is targeting to finish the amendment of IFRS 4 and the publication of IFRS 4 Phase 1 as amended in the third quarter of next year. So by September 2016, this whole process should be completed with an amended IFRS 4 Phase 1 standard that introduces the deferral approach for IFRS 9 as well as the overlay approach. The ISB staff then took the board through the classification and measurement of financial assets on transition, given that there is now a new set of measures regarding the application of IFRS 9. The transition measures within IFRS 4 Phase 2 for the financial assets needed to be reconsidered. And so for entities that adopt IFRS 9 prior to the new IFRS on insurance contracts, with or without the overlay approach, the board then considered whether to permit insurers to reassess their business models for IFRS 9 purposes upon transition to IFRS 4 Phase 2. For example, these will be entities that fail the predominance test on the 1st of January 2018 and have to apply IFRS 9 at that point in time. It could apply to also to entities that have decided to adopt IFRS 9 in 2018, even if they pass the predominance test, or entities that have already early adopted IFRS 9 today. So all these entities would have the benefit of a revised set of transition provisions within IFRS 4 Phase 2, which I'm going to explain to you in a moment. The first recommendation in this section of the standard that the ISB staff put forward would permit entities to reassess the business model for financial assets which are designated as related to contracts within the scope of the new IFRS for insurance contracts. So this would apply to assets held to fund the insurance contracts based on the expected amount of claims and expenses, but also to surplus assets which would be held in case of unexpected increases in insurance liabilities. They would not apply to other financial assets held by an entity for a purpose clearly other than backing insurance contracts. One practical point that will have to be discussed is whether the capital that insurance regulations may require an insurer to hold, calibrated against liabilities which are both in the scope of IFRS 4 Phase 2, like insurance contracts, as well as other liabilities which are typically regulated by insurance capital regulations, like investment contracts without participating features, whether the entire capital prescribed by those regulations should be taken into account in this designation or not. It's a matter of practical application of the standard, but is one that I wanted to bring to your attention. Two important points to make up the first recommendation are that on transition, entities will be permitted to designate and de-designate equity investments with regards to the equity presentation. As you know, IFRS 9 allows you to account for equity investments either at fair value through P&L, which is the standard accounting measurement for those instruments, or to elect to account for them at fair value through OCI, which is different from available for sale because it doesn't have impairment and it doesn't have recycling of realized gains and losses outside other comprehensive income. The second point that goes with this business model reassessment is the fact that on transition, both mandatory and elective use of the fair value option can be reassessed and changed. So two very important concessions on this designation of under IFRS 9. The second recommendation is that the reassessment will be based on the facts and circumstances that will be in existence on the initial application of the new insurance contract standard. That is, the beginning of the latest period presented in the financial statements, with new classification designations applying retrospectively. Any resulting changes would adjust opening retained earnings. So there will be a retrospective restatement. Important here is to actually talk about some specific dates. So let's assume that the effective date of IFRS 4 Phase 2 is the 1st of January 2020. The date that this recommendation is referring to is the transition date, which is the opening balance sheet of the comparative period. If you are a company presenting financial statements with 2 columns, a current period and 1 comparative period, that will be the 1st of January 2019. If you are a company instead that presents 2 columns of comparative information, that will be the 1st of January 2018. So it is the information that must be contemporary at that point in time that will have to be taken into account for this assessment of the business model as well as the designation. So that's an important practical point to keep in mind as we prepare for the adoption of the new IFRS 4 Phase 2. The requirements will start to be biting us much earlier than we were anticipating in terms of contemporary information that needs to be analyzed and decisions that need to be taken in order for subsequent accounting policy elections to be possible. Let's have a look at the discussion that the IASB had on these 2 recommendations. There was some discussion about whether reassessment was actually similar to a change of business model, and the board asked the staff to clarify in the drafting of the new standard that reassessment of the business model does not imply that the model itself has changed. That's a very important practical point again, but in the light of the new standard, or the new IFRS 4 Phase 2, and the new circumstances that may exist at the time of the reassessment, then a different classification designation would be appropriate from an entity point of view. So this is an important practical point because it doesn't actually require the change in business model, which the IFRS 9 text has told us is a rare event. That makes a much more plausible scenario, the one of change, not because the business model has changed, but because its interpretation against the new set of requirements may lead to a different conclusion. It was highlighted that these reassessment and redesignations are optional, so it's not going to be a requirement for everyone to do. Some board members also wanted to emphasize the need to explain the reasons for the reassessments and redesignations, whereas others argue that this information implied some necessary conditions which were not actually explicitly stated, and eventually that point was dropped, so we should not be finding narrative or text in that regard. After that, the board approved both of the staff recommendations unanimously. Then the IASB looked at the restatement of comparative information on initial application of the new insurance contract standard. Now here we need to bear in mind that IFRS 9 does not require a restatement of comparative information for initial application of the classification and measurement requirements, but it permits it if it is possible to do it without using hindsight. Now, when we compare that regime with the one that was presented and subsequently approved in the 2013 exposure draft, we can see that over that standard we'll actually find a comprehensive requirement of always restating financial information for insurance contracts. That compelling requirement for restatement has made the issue of practicability an important one, and so the exposure draft contains already a simplification of the restatement, which has been further elaborated with a third component of the transition provisions, which is the fair value approach for restatement. So we have both full restatement, simplified restatement, and a fair value approach, 3 possible restatement methods, always targeted to provide a full restatement of the insurance contracts on transition date. So against that background, the discussion and the decision of the IASB revolved around a couple of points. Again, this discussion was fairly quiet. One board member, for example, noted that the use of the hindsight could be avoided if insurers are given sufficient advance notice of the requirements, and therefore they could collect the necessary information on a contemporary basis at the right point in time to avoid the actual use of hindsight. And given that the IASB is targeting to publish the standard by the end of next year, that is well ahead even of the earliest of the transition dates, the 1 January 2018, that will be applicable to insurance entities that present 2 comparative columns in their financial statements. After a brief discussion, the board agreed to reconfirm the intention to require all entities to restate the comparative information for insurance contracts. However, the board tentatively decided that entities already applying IFRS 9 on initial application of the new insurance contract standard and that take advantage of the transition reliefs, and that's the important point, and take advantage of the transition reliefs, should then restate comparatives for financial assets. So this is only if you have been using the transition reliefs and therefore you have pushed forward the full effect of IFRS 9 to a later stage, then you will have to perform a full restatement not only of insurance contracts but also of financial assets. And you will have to have the requirement effectively coming in with the transition relief final text next year to build the necessary contemporary documentation to enable you the election of those provisions that will appear in the final text of IFRS 4 Phase 2 as far as restatement of financial assets is concerned. So that is all the board has done on IFRS 9 and IFRS 4 Phase 2 interaction. Then they moved on to the mirroring approach discussion. And you remember the mirroring approach from the 2013 exposure draft attempted to introduce an accounting system which was designed to eliminate accounting mismatches between financial assets and participating insurance liabilities. This was something that received substantial negative commentary from the comment letters. Deloitte was among several constituents that commented negatively about the practicality of the mirroring approach, and also the fact that it would produce, in a number of instances, inconsistent measurement within the financial statements. The variable fee approach was eventually approved in June this year by the IASB as the solution for at least direct participating contracts. The recommendation of the staff was that given this state of affairs, they would recommend that the IASB prohibits, in fact, the use of the mirroring approach and removes it completely from the future text of IFRS 4 Phase 2. They have also warned the IASB that that decision will not be universally welcome, and there will be a number of insurance entities, in particular mutual insurers, that may not be entirely satisfied by that decision. And so the discussion was clearly triggered by that particular warning. So entities with potentially no equity, for example, mutual insurers that capture the entire surplus within the business in the CSM, may have found that the mirroring approach was actually relatively easy to apply to their financial statements because of the absence of any interest allocated to other owners of the business other than the policyholders. It was noted during the debate that there could be circumstances in which the residual assets of a mutual may actually not be entirely attributable to policyholders, and so in those instances there will be mutual with equity, unlike others that may have no equity at all. Clearly that became, during the debate, an issue of equity versus liability classification, and the board eventually noted that this accounting matter is covered by a specific project which is currently not an active part of the agenda, but it will be so in the future, and it is not in the scope of the insurance project to resolve it. So the conclusion of that was that by unanimous vote, the IASB decided that the mirroring approach should not be permitted or required. Now, although the decision that the ISB has reached clarifies the recognition of measurement principles for direct participating contracts, in the sense that the now mirroring approach is out and the variable fee approach is the only thing left, this leaves the accounting for indirect participating contracts an issue that is by many accounts unresolved. And the staff paper so far appears to indicate that the ISB is moving towards restricting the variable fee approach to direct participating contracts only, and that could create some undesirable consequences in terms of the faithfulness of the representation in financial statements of how profit will emerge from the indirect participating business. And that is one of the two major issues that I mentioned in the title of the webcast today, remains still open for debate. Let me now move into the third and final part of the discussion that the ISB had on their October meeting, and that is presentation and disclosure. The staff paper here is quite a comprehensive one, actually, and really summarized all the impacts on disclosure and presentation that the redeliberations and the developments since the June 2013 exposure draft were published have been creating on those requirements. In particular, the fact that there is now a variable fee approach for contracts with direct participating features, that there are modifications in the presentation of interest expense when the OCI solution is adopted, and also there has been the publication of the IFRS 15, the revenue standard. So the paper does an analysis of all these changes and puts forward a series of recommendations. I would like to cover the discussion by capturing some of the topics that the discussion has brought up. These are not necessarily going to be in the decision, but it's important that you appreciate what was said. The discussion in this instance actually was quite lively, and the comprehensiveness of the paper and the fact that there are several topics really generated a lot of comments from the ISB present at the meeting. And so we have tried to capture the key points that emerged from the debate. The first one is on the disclosures for the OCI solution. And here the staff clarified that an entity would need to keep track and disclose the movements in the financial asset designated as related to insurance contracts at the date of transition. Remember, 1st of January 2019 if you are a 2-year financial statements company, or 1st of January 2018 if you are a 3-year financial statements company. And those assets effectively will have to be reported on transition and in each subsequent period if you have declared impracticability on the restatement of the accumulated OCI reserve. So that means that if you go back to the decision in September, that simplification of the transition, whereby if you are using the cost-based measure for presentation, you will be allowed to effectively set to zero the accumulated OCI reserve for your insurance contracts. And if you're using the current period book yield approach, you are setting that reserve to be equal to the OCI reserve from your assets. That simplification will generate for those entities only a requirement to actually ring-fence those assets by designation and then report at each period the movement in the OCI reserve of those assets. And that debate actually seems to have generated some consensus, which we'll see in a moment, generated a positive decision of the ISB. The other topic during the discussion that we felt was important to bring to your attention is the one on disclosures on different methods to measure insurance contracts. This is actually not one that generated a particular decision later on, but it's important to understand that board members considered the need to present separately insurance contracts measured under different methods. For example, the premium allocation approach, or PAA, and of course the recent variable fee approach. Some board members felt that the measurement simply reflects the different features of the contracts, and so they were not actually considering that there was a real need for separation of insurance contracts across different measurement. Others pointed out that actually, when you look at the VFA, you do have quite a substantial difference in the emergence of profit, and so that could be actually in itself a reason for separation of the VFA accounted contracts from the others. Overall, the two camps were reconciled by saying effectively that they would not specifically introduce any particular requirements, but they would highlight in the final text of IFRS 4 Phase 2 the IS1 requirements to present separately items different in nature or with different features, so that their emphasis will be given over an existing requirement rather than introduce a new one. It's worth remembering that there is merit in the first camp, because although it is true that the PAA is just an approximated building blocks approach, and so the profit emerging from using the PAA or the BBA is not materially different from each other, and that actually is the premise for the PAA being applicable in the first place. The VFA does produce materially different profit recognition patterns, and that is why the material issue around indirect participating contracts remains on the table, because of the two, if you like, the two halves of the universe of participating contracts being treated in substantially materially different way, depending on whether the participation mechanism is direct or indirect. The other 2 points of this that emerged in the discussion that I wanted to share with you are the disclosure for the VFA. Here there was again lively debate on the onerousness of the and the usefulness of the staff proposal for the 2 CSM roll forward calculations when you apply the, as I like to call it, the VFA hedge accounting that the IASB approved in September. Remember, this is the fact that if you are buying some interest rate swaps, for example, to hedge your embedded guarantees in the participating contracts, you will have the opportunity to take out from the CSM unlocking the component of the changes in the fulfillment cash flows that relate to those embedded guarantees and book them into P&L. So what the staff was proposing was effectively to have 2 different tables of roll forward for the CSM, one with the hedge accounting and the other one without it. And this was actually rejected, and so we'll see later on that this is actually not being taken as a component of the disclosure requirements for the future standard. The other one is the disclosures on the interest expense for the OCI solution. And there were a number of questions here that were raised by some board members during the debate as to whether the interest expense analysis should be done in a particular way. The staff recommended that there was no default position as between the use of a current rate or a locked-in rate. So it's not that one has got a preeminence over the other. They have actually avoided that statement to avoid effectively the issue of standard setting bias in the standard. Other board members question whether for entities choosing to present the effect of all changes in profit and loss, there should be some way to distinguish investing from underwriting activities. But the point is that the OCI solution is not designed to achieve that particular split. It's just there to focus on the presentation of the effects of time value of money, and that's it. And so also that issue was debated and resolved with a no action to be taken in terms of future decision for disclosure requirements. So after that debate, we can now move on to the decisions following the right order in terms of the paper. The first one is presentation, where there was effectively a unanimous confirmation that all the presentation requirements in the 2013 exposure draft, in particular the insurance revenue, were confirmed, and there was nothing that the redeliberation in the last 2 years have led the board to believe something had to be changed. The second decision is on the set of disclosures for the VFA, and here for entities applying the VFA and recognizing the changes in the measurement of the guarantees in profit and loss, the so-called VFA hedge accounting, decided in September, the amount of the CSM plus the amount of guarantees recognized in P&L for the reporting period will have to be disclosed, but no double reporting of movement tables, just one table movement as before, with just the amount being reported in P&L hitting the footnotes as a disclosure. Then quite a comprehensive decision on disclosures for the time value of money when the OCI solution is used. So if an entity chooses to disaggregate the interest expense between P&L and OCI, the standard will require the disclosure and explanation of the method which has been used to calculate the cost-based interest expense. Of course, we all have learned from the webcast we gave you last month that in September the ISB agreed that they will not impose any particular mechanics on calculating the interest expense in the P&L. So there will be no requirements, but just an objective, which is the method has to be a cost-based measure. And this obvious disclosure requirement will effectively impose on the entity to explain what is the method adopted. Entities that are using the simplified restatement, the one that effectively set to zero the OCI accumulated reserve, or uses the asset OCI accumulated reserve in the event that you have adopted the current period book yield approach, will have to disclose what are the financial assets on transition date, so 1st of January 2019 or 1st of January 2018, depending on whether you are a 2- or 3-year financial statements company, which relate to contracts in the scope of the standard and for which the transitional simplification has been adopted, and also disclose on transition and in each subsequent reporting period, and that's a very important point, a reconciliation from the reporting opening balance to the closing balance of the accumulated balance of OCI for those financial assets. So you have avoided effectively the restatements on the liability side, but the price you have to pay is that you will have to monitor those assets and provide a reconciliation effectively to show how much of the OCI simplification is going away from the asset side, given that you have not done the job on the liability side. And that is because this runoff of disclosure requirement needs to take into account that from transition date onwards, the entity will be applying the OCI solution properly, and so building up an accumulated OCI reserve year after year that is not benefiting from a properly restated opening balance. And that's why the distinction between the growth in the accumulated OCI reserve, whether it's a debit or a credit, who knows, we'll see in 2018 or 19. But given that accounting mechanism effectively going to happen, the board felt that there needed to be something to inform the users as to what had not been done because of the simplification on transition in terms of the past accumulated OCI reserve for insurance contracts. Then there was a set of disclosures on the CSM. Now, this is another interesting set. The first one is that for insurance contracts that do not use the VFA, the entity will have to disclose the changes in fulfillment cash flows that adjust the CSM. And that is following, again, the principle that was clarified in September that changes in the fulfillment cash flows will be divided in two broad categories, those that do adjust the CSM because they are not affected by market variables, and those that are affected by market variables, which will have to be classified either entirely into P&L or being split between P&L and OCI. And so that's why the disclosure on the adjustment to CSM has now been put through. And for all insurance contracts, there should be the disclosure of an explanation of when the remaining CSM is expected to be recognized in P&L. This could be done either on a quantitative basis using time bands or using qualitative information. There should also be a disclosure of the amounts in the financial statements which are determined using the simplified approaches for transition restatement. And this information is not only on transition, but also in subsequent periods. So you effectively are ring-fencing in the balance sheet those components of the CSM that have been calculated using the simplified restatement or the fair value approach, and show them on a reconciliation basis, another table, how they've moved from the opening balance in any period to the closing balance in the same period, such that there is a disclosure that allows investor to monitor the runoff of those CSM components from transition date up to the point of complete derecognition through P&L. If those simplified approaches have been adopted, there is also going to be a requirement to disclose what practical experience the entity has used in developing the simplified restatements. Finally, the deletion parts. So these decisions so far were all new disclosures, but there are also two disclosures that will disappear. The first one is the requirement to reconcile the insurance revenue, the new insurance revenue presented in P&L, to premiums received in the period. This was paragraph 79 of the 2013 exposure draft. This requirement is effectively a duplication of the roll forward table for the balance sheet amount, and so the ISB decided to delete that completely because it was duplicative. And the other one that goes, not because it's eliminated completely, but because it's replaced, is the disclosure of the analysis of the total interest expense between P&L and OCI, given that now we have the new disclosures that the ISB approved in October with the new OCI solution as deliberated in September. And so those disclosure requirements approved on the 21st of October replace the old ones which were approved in March this year during one of the redeliberation discussions. So that completes my account, hopefully informative account for you of the board meeting on the 21st of October. So let's now spend a couple of minutes to understand what are the few remaining next steps. This month, in November, the ISB is looking to discuss the differences between the building blocks approach, which is the general model for all insurance contracts, and the variable fee approach to assess whether there are some modifications that will have to be taken. This is where we hope, as a firm, as Deloitte, that the two remaining material issues will be debated. The first one is the measurement of indirect participating contracts. Currently, from what we can see in terms of staff papers, the ISB appears to be restricting the application of the variable fee approach to direct participating contracts, and several constituents, including Deloitte, have appealed for that decision to be reconsidered, given that there are very great similarities between those two subsets of insurance contracts in terms of economic behavior. The other one is the use of the concept of unit of account. The protracted discussion on the many different components of the standard has now left several constituents unclear on the effective direction the new IFRS will take on this central recognition and measurement requirement. And so we hope that clarification will be delivered through the debate on the comparison of the two main accounting models within the standard. Deloitte was had provided already a lot of comments to the ISB in our 2013 comment letter, and all of them remain very much valid. And so we have highlighted their contribution, plus offered additional thoughts that we hope can help the unit of account, which is such a new concept in the standard, be explained clearly in the final text. Obviously, the mandatory effective date is another point that will be decided, but this will be done only at the end, when all the other matters that are being discussed have already been deliberated. The ISB expects to complete these deliberations this calendar year. There is a possibility perhaps that January 2016 may also be used. We'll see. I think that we are now in the final stages, really. So it's 2 or 3 board meetings left, probably. And then the drafting and the balloting of the standard will begin with a publication that is likely to be towards the end of 2016. That is all I have to say for you today. Here you can see in the final slide where you can find the replay of the webcast, plus all the other documents and publications that Deloitte produces for you to keep you informed on the development of this important project. And with that, I would like to open the floor for any questions you may have. Thank you.